Hello everyone, welcome to Kajika Trades. Today I'll be going over how to trade with some insight into how I personally trade. If you could take a moment and like and subscribe to the channel, that'd be great. I'm trying to grow the channel as well as meet some new people. Today in the video, we'll be going over hardware and software equipment you need. What is it you need to trade? We'll be going over how you should approach trading, risk management strategies, and then at the end, we'll be looking at some basic charts. So hardware and software, big question. Do you want to have the portability of a laptop or be stationary with a desktop? Either option is fine. They have different price points, but one of the most important things is make sure that whatever brokerage software you use, that it's compatible with a Mac if you go down the Mac route. So brokerage. Personally, I use TradeStation. I like it. I like their user interface. I like their the order fills. I like all that. It just works for me. I think it's professional, but anything you want, each person has their own. Some have commissions, some don't. You can find what you like. Additionally, you're gonna need a chart analysis software. TradeStation has their own chart analysis, and most brokerages will provide their own chart analysis. But I like to use TradingView, which is free online. I just think the interface is better, more user friendly, and it's just better for me. Like I said, it's online for free, but that's the basic package. If you upgrade to the pro package, which I need for what I use, there are other more expensive packages, but this has all my needs filled. It gives me access to 2-minute time frames, as well as to have up to 5 indicators active at the moment. I will link below the video reference that if you sign up using the reference code, we'll both get $30 off one of their whatever package you subscribe for. So, like I said, we're going to go over how to approach trading, and I like to put an emphasis on operating your trading like it's a business. And we have this image here with Warren Buffett, who's the CEO of Berkshire Hathaway, legendary investor and trader. And he says, rule number one, never lose money. Rule number two, don't forget rule number one. And why I put this here is you got to remember that, like I said, we're separating the self from the business here because that's why we want to be looking at our trading like it's a business. And that means that each dollar that we have in our portfolio is essentially a worker. If we lose a dollar, we lose that dollar's ability to make us more money. So we need to constantly be trying to limit our downside risk so we have as many dollars as possible to make us more money in order to be profitable over the long run. And on the right here, I have this table and I have the question, who was more likely to be emotionally stable? If you want to answer that real quick, you can see over 4 weeks, Trader A and Trader B both came out profitable $150. Who was more likely to be emotionally stable? In my opinion, I would say Trader A. The reason being is you see the drawdown between the highs and lows is less, as well as the fact that um, they're probably better at sleeping at night. This didn't, this 2 week period probably didn't come over into their um, day-to-day life. You like I said, we want to separate business from self here. We don't want our trading to influence our life or our life to influence our trading. They're two different things. One's a career and one's, whatever we do in our spare time. So now we'll go into risk management. And in my opinion, effective trading is light and free flowing. And what I mean by this is you're going to every trading, you know your plan, you execute the plan. There's no wavering from it. You have a plan, it's in place, and the plan trades itself rather than you having to make decisions in the midst of things. The decisions are already thought out ahead of time. And with risk management, it needs to be applied to every strategy you use because in order for an entry strategy to be effective, regardless of what entry strategy, whether it's the one I'll go over in later videos or one that you read about, found, or developed yourself, you need effective risk management in order for it to be profitable in the long run. Because you could win 90% of your trades, but if those 10% you're losing, if you're just losing so much money in that 10% that you can't make it up with the other 90%, obviously you're not going to be profitable. So one risk management strategy that I use is the 1% rule or daily loss limit if you want to up your risk. So with a portfolio of $10,000, risking 1% a day is risking $100 a day. That means you can take as many trades as you want in that day, but your accumulative losses can't be more than $100. So if you take your opening trade and you lose $50, how I approach it, I would come into my second trade, I would size down and make it so whatever my risk was, the most I was losing was $50. So I lost 50 on my first trade, I risked 50 on my second. If I lose my second trade, I lost 100, and I call it quits for the day. And my head just isn't there. I'm just not seeing the market that day. I step away and back to rule one up here, never lose money. So we're trying to limit how much money we're losing, how many workers we're losing. Now we'll look at some charts. This is a basic line chart. We're looking at Amazon price action. You can see on the x-axis here we have the date. This will always be a time. And intraday time frames, obviously, it's not going to be months or days. It'll be just the minutes. On the left, or most likely you'll see on the right, is the price action. And this is showing you the closing price of each one of these points. So if you go here, say this is, I don't know, March 12th, and you go up on March 12th, we close around $1,600 in Amazon that day. This is a basic chart. What you'll see most traders use is something called a candlestick chart. So you can see here we're looking at C, so Citigroup on the 2-minute candlestick chart here. So how we would read this, once again, this is 2 minutes. So each of these is a 2-minute time frame in between. So between 10:30 and 11:30 minutes. So there's 15 time intervals of 2 minutes in here between these two lines. You can see represented by each of these candlesticks. On the right side, we have that price action. So we would read this, okay, opened here around 2050, 2040. We had a move up into 11 o'clock around 2060 to a 20-cent gain. And then towards the end of the day, it fell off and we closed around 2030. So that's how you would read this. But looking at each individual candlestick can also teach us a lot, and we can take a lot of information from these. So on a green candle, the open is the bottom of the body. So this rectangle here is the body. This rectangle here is the body. But on a green candle, the open is the bottom and the close is the top. And it's the opposite on the red candle. So the open is the top, and price action came down and closed down here. So the wicks are telling us that if we opened here, the price came down to this low point, came up to this high point, but closed here. So there was price action between this close and this high, but the end of that 2-minute, this is where the candle was valued at. So you can see where we got 2 wicks right here. So price came down this big red bar, and I'm looking at this bar right here. You can see we opened here, price came down to the 2050 level, rejected off of it, came up probably, I don't know, 2054, closed at 2053. So our body is that between that 2051, 2053, but we had a wick down to 2050 and a wick up to 2054. So that's how we would look at that. And thank you for tuning in. Check out my Twitter and my TikTok where I'll be going over trades and sending out trade ideas live all the time. Once again, thank you. Have a good day.